So let's move ahead with the session number 2. Let's try and find out what do we have on the cards today. We are going to be discussing about multi-time frame trading. Okay, multi-time frame. What do you mean by multi-time frame? Multi-time frame means that you are going to participate in more than one time frame. So you are going to focus your attention on more than one time frame. And why is that important? Okay, why is that important is because market is very well connected. It's just that we are not able to connect the dots. Now, to ensure that we are able to connect the dots, we need to pay a lot of emphasis on what are the higher time frames saying. All right. So what exactly is multi-time frame trading? So multi-time frame trading is a process of viewing the same stock or same asset class across different time frames. So you will take a daily chart, then you will take an intraday chart. So now when you are going to participate in the market, you should have essentially two kind of charts. Okay, you should have essentially two kind of charts. One is called as a chart of choice, other is called as a chart of execution. What do you mean by a chart of choice? Chart of choice means the chart on which you will do your analysis. And chart of execution means the chart on which you are going to take a trade. So the chart on which you are going to take a trade will be the ones which will give you your entry stop loss target. All right. While the chart of choice will be the one which will give you the overall trend in that particular stock. Okay. All of you need to understand this so that when you go into the market and when you try and read the market, when you try and understand the stock setup, your clarity will be there. Otherwise, you just check, analyze on one stock, and then you take a trade based on the same time frame. What happens is that the overall connectivity is not there, and often you will see that you have exited the trade wrongly, or you have not been able to hold on to the trade, and that causes a lot of anguish because you are not very clear about the overall trend in that stock, right? So why you need to do a multi-time frame analysis is because you are engaging in a top-down approach. A top-down approach is one of the easier way to participate in the market. And what do you mean by a top-down approach? Top-down approach means you take a look at the higher time frame and then you step down. Yesterday, what did we do? We took a look at the markets, then we took a look at the sector, and then we take a look at the stocks. That's what we discussed. So this is the kind of pattern which we will follow, and I will demonstrate it to you in the live market session. But now coming back to this, what is the benefit of doing such kind of trading? When you engage in a multi-time frame trading, it improves the odds of your success. It makes it possible that yes, whatever you have analyzed, whatever trade you're going to take, the chances of the trade to succeed is very high. And that's why it is very important. And when you do a multi-time frame analysis, one of the biggest benefit is you don't have to stay in front of the trading screen. Many times we engage in just sitting in front of the trading screen and waiting for our trade either to meet the target, or sometimes we have no control over our emotions. We exit our trade thinking that yes, this trade is not right, and then we realize that oh, this trade was right. I was wrong in exiting that trade. And when you engage in this kind of trading, it makes it very rewarding for you because you have got a very good idea of what is the risk to reward you can expect in this trade, whether it is of a short-term nature or whether you can actually expect much more than what you are anticipating. So that is the advantage of doing such kind of trading, a multi-time frame trading. Now, how do we do that? Okay, how do we do that? So for that, you have to understand the higher time frame. And what does a higher time frame tell you? A higher time frame tells you that where is your standing? Where are you as far as the overall setup is concerned? And when a higher time frame is seen, okay, a higher time frame, like if you're going to do intraday trading, then a daily will be your higher time frame. If you are going to do a multi-day trading, then weekly will be your higher time frame. If you're going to do multi-week trading, then monthly will be your higher time frame. That's how you are supposed to analyze and then review and then shortlist your candidates. That's the whole idea here. And when you do that, it becomes easier for you. Now, higher time frame will give you a perspective, and lower time frame will help you execute the whole activity of trading better, right? And why does it help you? Because you will have certain stop losses, you will have certain targets, but then if you do it based on the higher time frame, it becomes very challenging as a trader to actually execute them, right? We want to drill down and find out what are the more achievable levels, and that is why you should have a lower time frame. You will execute it in the lower time frame, analyze it in the higher time frame. All right.